Jared, how you doing, man? Today is the day. Night Moves is officially out. I picked up my copy. It should be here tomorrow. I'm going to be camping out outside my door, going to prop up my beach chair, and I'll be ready for it.
You know, it's funny. In the new house, we have a library. It's a beautiful library, and we bought this very expensive restoration hardware sheepskin chaise that is the reading chair. And it's the most comfortable chair in the world. You just get in this thing, you get a book, you can read for hours, and it's a quiet space. You can't hear anything. It's the best. But anyway, this book, Night Moves, is meant to be read slowly. Like, I don't want people reading it in 2 hours and then posting a review. Read one story at a time, 2 stories at a time. Don't just like plow through it. It will be tempting to plow through it, but don't do that. Read a story and reflect on it. That's what you're supposed to do. So
let's move into the market headlines then. First up, we have bank investors are now betting 2024 could be the start of another 1995. The start of a new rate cutting cycle at the Fed has bank investors hoping for a return to 1995. That was the year the banking industry began one of its best runs in U.S. history following a series of new rate cuts from the Fed and a soft landing engineered by then central bank chair Alan Greenspan. An index broadly tracking the sector finished 1995 up more than 40%, outperforming the S&P. And that outperformance, by the way, would hold for another 2 years. So, Jared, do you have any thoughts right now on this? Could this happen again?
I doubt you'd see banks up 40% a year, but I mean, maybe it could happen. If the Fed keeps cutting, the yield curve's going to steepen. The back end already acts like shit. So it's totally possible the yield curve could steepen 100, 150 basis points. Bank stocks could go up 15 or 20%. That's for sure. Like, that could happen. Things are different than they were in 1995. There's a lot of things that are different. Because of Dodd-Frank and other regulatory stuff, banks are required to hold a lot more capital than they did in the past. So their returns on assets and return on equity is going to be lower. They're just going to be slower growth businesses. So that's kind of why I say that you're not going to see 40% in a year. But yeah, I mean, for sure, it could be a good year for bank stocks.
We got to talk about gold. So gold rises to record high before U.S. data that may give Fed clues. I see gold now is at about 26.53. It touched a record high ahead of U.S. data that may offer clues on whether the Fed's 50 basis point rate reduction last week will be the first in a series of aggressive cuts. Bullion rose as much as 0.4% to hit 26.31 an ounce, beating the previous all-time high posted on Friday. Traders are weighing the outlook for rates ahead of a batch of crucial economic data, including the U.S. personal consumption expenditures gauge and jobless claims due later in the week. How do you feel about this bullish momentum in gold? Does it give you any pause in the near term, or do you think it's going to continue to just rip?
No, I think it's going to continue to rip. I mean, the only thing that's gold is vulnerable to is hot economic data, and we could get some. PCE could come in a little hot. Claims just refuse to go up. Like the job, it's funny because we just cut rates 50 basis points, and we're pricing in all these other rate cuts, and the unemployment rate is 4.2%, and claims just are not responding. So the labor market is still strong. So yes, if you're long gold, you could take a $20 or $25 hit on a piece of economic data. I think it's going to bounce back. If you're long, just set a stop, and just let the poison take effect. The next resistance isn't really till 3,000. So.
Next headline, have you heard about this Trump proposal on short-term cap on credit card interest rates?
Yeah, it's funny because I have heard about it, and it's really terrible. It's the worst thing in the world. And Larry Summers was tweeting about it this morning, and he said, look, Trump wants to cap credit card interest rates, which is really, really bad. You'll have a shortage of credit. People will lose their cards. He also wants tariffs. He also wants to control monetary policy. And Larry Summers in his tweet said, if you're like a free market, fiscally conservative person, why are you supporting Trump? Which is, I actually retweeted him. I thought that was a reasonable question to ask. There is an answer to that question. And the answer is you don't want your taxes to go up, right? And it's not like Kamala Harris is any more free market than Trump. Let's be clear. And we've said it on the podcast a bunch that, if you had to choose between the two, the lesser of two evils is probably Trump. And also with Trump is, he's full of shit. Like he proposes all this stuff campaigning. And the saying about Trump is that you want to take him seriously, but not literally, right? So I don't think he's going to become president and cap credit card interest rates at 10%. Like you take him seriously, but not literally. Like he might do something else, but he's not going to cap credit card interest rates. I think there are smart enough people around him to prevent him from doing that. Kamala Harris, I'm not so sure. Like I think whatever she says, I think she's willing to follow through on, but she's not even saying anything. So, if you want to see the Larry Summers tweet, it's in my timeline. It's a legitimate question, and I thought it was an interesting tweet.
I mean, this reminded me so much of the Kamala Harris, price controls on groceries. So I don't know if this proposal is any better. It doesn't seem like it. Like you said, it's going to limit credit access.
I mean, really, if you wanted credit card rates to come down, you would deregulate. The credit card industry was regulated heavily by a bill passed by Elizabeth Warren in 2009. And at the time, rates were about 10%, and they promptly went up to 14%. And they've been going higher ever since. Like, if you really, the answer to all these things, usually, if you're talking about if the price of something is high, the answer is usually to deregulate. So that's the answer.
Getting into the first main topic, I want to kind of get your take on kind of your macro view now that you're talking about we're in this kind of Goldilocks period. Can you talk about stocks, bonds, commodities outside of gold, kind of what you anticipate for the next few months?
Yeah, we are in a Goldilocks period. The Fed is cutting and everything is fine. Like that's, if you could sum it up in one sentence, that's what it is. The Fed is cutting and everything is fine. So stocks should go up. Bonds should go down. Interest rates should go up. Commodities should go up, ex gold, and gold should go up. It's a very easy trade. And really the only thing that stands in the way of that thesis is really the Fed changing its mind, which it's not going to do. Like once the Fed changes direction and starts cutting or hiking, they typically don't do a one-off cut or a one-off hike. It turns into a cycle that lasts for a year or more. So, the Fed's going to cut rates maybe in November, maybe in December, maybe in 2025. But, my position is that they're going to cut at least 150 basis points. You're going to see Fed funds at 4% at a minimum and maybe lower. And until we start getting towards the tag ends of that and we start pricing in hikes again, this Goldilocks environment is going to continue.
For Fed rate cuts, do you predict it'll be kind of a series of methodical 25 cuts, or do you think they'll go aggressive again at any point?
I really don't know. And I don't think anybody else does either. We have a lot of Fed speakers this week. We have like 12 Fed speakers this week. Probably get some clues from that. Really, I would say the two Fed officials to pay attention to are Christopher Waller and Austin Goolsbee. They probably have the most intellectual weight at the Fed, and Goolsbee has been talking about cutting aggressively, like very aggressively. Waller, I think, is a bit more measured, but if you see either of those guys speak, I would pay attention.
Second main topic, I want to talk about the job market a little bit. Not to turn this into another one of our Reddit deep dives, but I was trolling the r/jobs subreddit, and I've seen some headlines like WTF is going on, job market is so bad, giving up and applying to McDonald's to pay rent, rejected by McDonald's even though I have 1 year of experience in banking, and lastly, I am tired, should I give up? I mean, a lot of this is probably venting. People seem to flock to Reddit to vent on their lack of job prospects, but I do know some people that have been laid off this year and have had just a hell of a time finding new jobs. What do you make of the job market? And really, how do you stand out nowadays when you're just throwing out resumes by the, I don't know, employers get hundreds, if not thousands from people?
There's a lot to talk about there. So the jobs market is a bit worse than it was a year ago. Not so much in terms of the unemployment rate, but in terms of job openings. If you look at the JOLTS data, if you look at job openings, we went from about 11 million job openings to about 7.5, right? So we're still not at the point where it's like really hard to find a job. It's harder. I mean, if you could fog a mirror, you could find a job during the pandemic, but we're not in that environment anymore. So I would say we're kind of back to normal right now. This is kind of a normal job market, and which means that you do have to work a little harder than you did a few years ago. But the people who are posting on Reddit are probably young, and they probably haven't seen a full cycle. They probably weren't looking for jobs in the Great Recession when the unemployment rate got up to 10%. Like that's when things were really dire. So it's a little tougher than it was before, but it's not really tough.
Let's go over to the week ahead. Coming up, we got second quarter GDP due Thursday. Friday's scheduled release of the Personal Consumption Expenditures Index, which is the Fed's preferred inflation gauge. And then lastly, unrelated, but we got some upcoming earnings, including Costco. You're a Costco guy, aren't you?
I am a Costco guy. I think I told you they only take Visa cards, and I don't have a Visa card, so I have to pay cash. So
weird.
Yeah.
Any thoughts on upcoming data, GDP, PCE?
The only thing I'll say about PCE in particular, and I suppose this applies to any of the data, is if it comes in hot, you're going to get a short-term blip in the markets, but don't be scared. It doesn't really matter because the Fed is going to ignore it and cut rates anyway, right? like that's really what's going on. Like if I don't know what the estimate is for PCE, but let's say it came in hot at like 3% or something like that. And, like everybody would freak out like, oh my God, the Fed's not going to cut. The Fed is absolutely going to cut. Like it's, so the data almost, I don't want to say it doesn't matter, but it matters a lot less than it did last month or the month before. So
right.
We're on a preordained path.
Any last words about night moves? I read the introduction last night. I got the preview. Very bold intro. I liked it though. Calling out the whole literary game there, kind of.
Yeah, it's funny because the guy that blurbed it here, Joe Oesterreich.
He works at Coastal, right?
Yeah, he's a friend of mine. He's a writing professor. He said the same thing. He's like, that is a very bold intro. Like, like I am calling out the whole literary universe. And look, I hope people read it, and writing that intro is taking a risk because I think the stories are good. Maybe they suck. If they suck and I wrote that intro, then it's going to be terrible, But I think the stories can stand up to scrutiny. I can't wait for you to read the whole thing. We can talk about it next week. But there's 16 stories in here. You have to buy Night Moves, $18.99.
It's a steal.
So, yeah.
How many hours do you think that took you to write for $18.99?
Yeah. And the funny thing about books is this is how bad the book business is. We had the biggest inflation in history and book prices stayed the same. They stayed the same. This book, if it went up like CPI, should cost like $30, and it's exactly the same price as before the pandemic. Like the book business is awful. So just, buy the book, read it. It's the cheapest form of entertainment you'll possibly get. Like if you went to see a movie that was, let's say Dune Part 2, it's 3 hours, right? And you spent like $18 for a movie ticket. That's like $6 per hour. This is like $2 per hour. It's the cheapest form of entertainment there is. So,
Dune Part 2, though, good movie.
That was a very good movie.
Yeah,
that was very good. Yeah.
Well, I'm gonna get my copy tomorrow. Hopefully, this is annoying, but I'll probably text you as I read through them and give you some thoughts. And then next week, I should be done with it and we'll go through it a little bit.
Cool. Awesome.
All right, everyone, pick up Night Moves. Do Jared a solid. Let's get out of here. I got to go set up that beach chair outside. was good talking to you, Jared.
Thanks, Cam.